Fantastic. Good morning, everyone. Apologies for my late arrival and the technical issues we've been facing. It's great to have you all here, and we'll have to unmute you as you speak. We've got a fantastic panel to discuss the outlook for financial markets, and ultimately, it means the outlook for all other industries. I've been a great supporter of financial services, a great believer in financial services, and the role that they need to play in driving economic growth. It's been a roller coaster 10 years. In some respects, the financial crisis 10 years ago, a once in a lifetime event, was if we look at the bright side, was positive for the financial services industry, in that it enabled the financial services to have the right capital adequacy ratios and the right buffers to respond to an even bigger crisis, which is what we've seen from COVID. So in terms of today, I'd like to have your outlook in terms of how you see things evolving over the next 6, 12, 18 months. I know only a fool can predict what's going to happen, but you're in a better position than most to give us those insights, and also for us to be able to understand how things are within the banking and financial services sector in terms of supporting growth, how you're assessing risk, and where you see things evolving. So without further ado, maybe we'll start with Lucy Villa from Moodys to provide us an overview of economic activity, how you're looking at the pandemic. We saw yesterday that the World Bank and IMF had, who many people thought were a bit too optimistic in terms of the downturn, have revised their outlook and giving us bad news. I hope to. I'm in business, so I always try and look at the positive aspects as opposed to the negative. Or maybe you can give us your outlook at Moodys and how you see things evolving. Lucy, you'll have to unmute, and we're all ears. You'll have to unmute you, I believe. You're on mute.
Thank you. I can't. The host is the one unmuting me, so I was waiting to be unmuted, but that's fine. So I mean, if you just as a way of introduction, I'm from the sovereign risk group. So what we do is credit risk for sovereigns, for governments. Of course, within that pandemic crisis, the governments are really frontline in not just about fighting the pandemic, but also, and that's probably the most important thing that I want to discuss today, is how governments are supporting the economy through this difficult time, and the extent to which we should or we could expect a recovery. So from a pure economic growth perspective, we can debate the numbers, but I think there are no single economies where there will be where we will not see either a contraction or deceleration. If we're more Africa specific, I think that there are two main channels, and to be honest, the first one, the domestic channels, are channels that we see everywhere in the world at the moment. Of course, lockdown measures have taken a toll on economic activity, and there are no governments who can support an economy to their extent that would, bring the capacity of the economy at 100% of production capacity. So, of course, African sovereigns are being affected as other sovereigns in the world. Then you look more at the external channel, and here maybe what is unprecedented is really the fact that, as I said, there is no, in particular, the large advanced economy, all of them will either contract or decelerate. That has, of course, an impact for African sovereigns. Plus, you probably need to take into account some channels of transmissions that are more specific there. Workers' remittances, economies that usually receive, large flows of workers' remittances will suffer FDIs will fall this year. So there are a lot of external channels that may be more specific to frontier market countries that would even affect more, African sovereigns. And of course, the commodity prices that you need to add to that. So that's really, in the nutshell, the environment. In terms of recovery, so if we've tried to say COVID, we're not seeing, a very quick recovery in economic activity. And for most sovereigns, we're seeing the economy growing at a lower level than pre-crisis. And the one economy where we see maybe the biggest gap is Ethiopia. You may say growth was pretty high before, so that may be the reason why, but that's where we're expecting the largest gap. And then if I can say one word maybe on one last thing, which I think is important, is the policy response from the international community, with of course the World Bank and the IMF, you refer to them, with the G20 leading some initiatives. One initiative that we commented, and we had rating action based on that initiative, is related to the moratorium on debt or at least to bilateral creditors, but with a possibility to have private sector creditors, external creditors, participating in that initiative. And here, our position has been the following, is that one, the communication around this initiative, and second, the history about liquidity and debt relief tells us that there is a likelihood that in some country, private sector creditors will ultimately participate. And since our ratings speak for the credit risks, the risk of a default and ultimate loss for private creditors only, they don't speak for official creditors. Of course, that has, that has a significance for our ratings. So for that reason, we put certain ratings in the B category under review for possible downgrade. And the main reason for the downgrade and what we will review is the likelihood of private creditors being involved or not, and if they were, what would be the possible loss they would be facing. That has not been, I must say, is a blanket approach, and there are certain sovereigns that are participating in the debt service suspension initiative that has some small private sector external debt, and where we haven't started a review. I can name, for instance, Togo, small country in a big continent, but where, for instance, the rating remains unchanged at the moment.
Excellent, thank you for that, Lucy. I've got a couple of follow-up questions. So from someone who hasn't been following I've been following what the ratings agencies have done, but I don't know the internal process of the rating agencies. So I know when you downgrade or upgrade a company or a sovereign, but when you've looked at internally, when you've looked at this pandemic, are the ratings agencies and yourselves at Moodys, are you going to be a bit more lenient in terms of the normal red flags that you would look at to downgrade a country? Obviously, the reason I'm saying that, countries as the IMF said, these are unprecedented times and they require unprecedented measures. But it also probably means that we need to look at the whole global economic fundamentals very differently. So are you going to change, are you changing within Moodys how you would normally downgrade a sovereign or an institution in terms of the metrics? Are you changing the metrics that you're looking at for that? Are you going to be a bit more lenient?
We continue to do what we do. So as I was saying, ratings is a forward-looking view on risk of default for private sector creditors only, and ultimately the losses attached to that default. So that's what we do, irrespective of the context. within which we do that assessment. Of course, in our analysis, there are many things that we need to take into account. And we know that these are unprecedented times. This is an unprecedented shock. More so because, as I was alluding in my remarks, all countries in the world are affected at the same time. So if you compare to the normal shocks that we've been used to, or I have been used to, sovereigns since 2014 and European sovereigns before that, since 2011, we have seen shocks that tend to affect more a certain region or all exporters, for instance. I'm referring to 2015. What is very impressive is that all economies, all countries are affected at the same time. There is not one single one that we could say, not affected. And that's what is really unprecedented about it. And so, yeah, so that's for us something that taking into consideration. One last thing maybe that changes a bit, or makes the analysis more difficult, is that our ratings by and large ordinary. So what we say is that a AAA is a lesser risk than a AA1. AA1 is less of a risk than AA2. And at the moment, what we're facing is that most sovereigns are going to see their government debt jumping. So to which extent, ratings are still resilient to this, jump in government debt? And that's a fair question that, is keeping us busy.
Sorry, one very quick follow-up question. We had a summit last week with between African heads of state and the Chinese head of state and China in general. So there's been a lot of talk about Africa's debt towards China, which is possibly about 30% of its total external debt, give or take. And I know that China likes to do things on a bilateral basis. And I didn't hear anything exciting from last week's discussion. But did you hear anything exciting from last week's discussion that means that you've got a bit more confidence in terms of the moratoriums from China's perspective, in terms of delaying debt repayments or debt relief?
I mean, the DSSI, so the Debt Service Suspension Initiative, is coming from the G20. So that's, in and of itself tells you something. Then, in terms of its, the way it will be implemented, the timing, the details, no, there's nothing that I can say. Only that that's something that we're following on a case-by-case basis, precisely for sovereigns that have large debt vis-a-vis, for instance, China, but, other creditors, because, the picture can vary quite substantially from one country to another. So, yeah.
Fantastic. Thank you. Thank you, Lucy. I'm going to go to Nieros now. So it's, you could say, at the other end of the spectrum. So one is the sort of the sovereigns and the greater government perspective. And Nieros works, she's the head of the Africa list at the CDC. And they've been doing some fantastic work, working with fast growth companies, budding entrepreneurs that are the leaders of the future. And I know that you've been hosting a lot of webinars in terms of practical takeaways for businesses to ride this wave and what they can do, so tips. So you've been having lots of discussions with these future leaders, with these companies that are driving change on the continent and that are the future national champions. So can you tell us a little bit about those discussions that you've been having? So what are you hearing from companies on the ground, and how are they overcoming some of these challenges, or what are those challenges that they're overcoming, and how do we go from pandemic to post-pandemic? And I assume that it's not doom and gloom for all companies. I mean, for example, I know that in the healthcare space, in the digital space. Some of these companies are coming to the fore, and this is their element for them to thrive. So Neros, let's hear it from you, please.
Thank you, Omar. As you say, I'm sort of going to give a very different perspective, I think, from the rest of the panel, trying to paint a picture of kind of what the conditions are on the ground. So I'll just take the next couple of minutes to try and offer that context. As you say, I'm with CDC, which is the UK's DFI, and I run a market building program at CDC called the Africa List. So the Africa List consists of about close to 900 now, mid to senior level business executives, CEOs and founders spread all across sub-Saharan Africa. So we're in East, South, Central, West Africa. So it really is sort of a phenomenal platform from which to, as you say, kind of derive insights and keep a finger on the pulse of what's going on. Very interestingly, just quite late in 2019, around December of 2019, we published the inaugural Africa List Business Barometer. So now this is a survey that tracks business confidence in our member countries, aiming to shed light on conditions, and really give its readers and its audience a view of what's going on from the eyes of these private sector leaders. So, you know, we just launched, this was literally just 3 months before the first global lockdowns, aside from China. And the barometer indicated just a really high degree of optimism right across sub-Saharan Africa in terms of the local business environments. And this was despite ongoing challenges, right? So we had the inflation issues that were going on with the Zambian kwacha, et cetera, but still business leaders were feeling very optimistic. And of course, if you think about the backdrop of what was going on for sub-Saharan Africa at the time, the outlook was pretty good. The Continental Free Trade Agreement was on the horizon. That was offering the potential to lift economic fortunes right across the continent by removing these trade barriers that we all know exist. When you compare to sort of 52% of intercontinental trade in Asia, 73% in Europe, which would be one of the on the higher side globally. In Africa, there's just 16% in total of trade that happens within the continent. So it was just, you know, the free trade agreement was a really exciting development, and obviously under the current circumstances, it's understandable that the African Union has had to delay the launch of it to next year. But still, you know, getting that in place is going to be really critical to bolstering the continent's economic recovery and the prospects for businesses. And so it really needs to be a priority for our political leaders across the continent. But as you say, you know, I've been able to keep in really close contact with the Africa List members. Hopefully you joined some of our webinars, Omar, but they've been really, really well attended. So we've offered webinars, for example, to support business leaders in their crisis leadership and their crisis planning. And then beyond that, actually, we've also made sure to run quite frequent member polls to try and keep a finger on the pulse of what's going on. And I've personally myself, you know, picked up the phone and spoken to as many of the Africa List members as possible. So one really interesting poll very early on, around the first week of April, we ran a poll to understand what impact COVID-19 was already having on businesses. And at that point already, you know, absolutely no one said that the impact was highly positive. As you say, you know, we have the different businesses have fared well, as you know, you pointed out, healthcare, there's been the e-logistics, etc. But really only a small number, so less than 10% said that they had been impacted positively by COVID-19. About a third of them said that they had been impacted in a negative way, but still manageable way. And those members are saying that they felt confident that they would get through the crisis despite the uncertainty. But really about a quarter, which is a good chunk, said that they were managing, you know, what they described as sort of a significant set of challenges in their businesses, or even sort of level 3 crisis. And they admitted to feeling anxious and really overwhelmed by what was going on. So clearly uncharted territory, you know, for CEOs. And as you say, these are CEOs of some of the most dynamic businesses on the continent. And despite the lack of clarity, you know, this was an absolutely unprecedented event for absolutely everyone. Business leaders have no choice, right? You've got to keep leading, you've got to keep running your businesses. And so, you know, they were busy with setting up their business continuity plans, communication planning, managing, communications with all stakeholders, so across the spectrum from the staff to customers to suppliers, but really critically investors. So investor relations with banks, with creditors, and private alternative investors has really been critical. In fact, some of our member businesses report having been able to successfully raise funds during the crisis. So it was rare, but a few of them have. But in some way, every single business, I would say, has been focused on shoring up liquidity, as you mentioned, sort of on the sovereign level, but certainly it's happening as well on the business level, obtaining moratoriums where they've been able to. Some have, as I said, secured new lines of credit. And then others have had to put in some more, I'd say, creative contingent cash flow measures. In some cases, we've seen some instances of people pivoting their business model, their entire business models, just to try and ensure continued revenue generation, and really just nailing the key elements of their internal value chains to make that possible. At first, businesses were very focused, at least to the extent that they were able to, they were focused on managing a transition to remote working. This wasn't always possible, obviously, depending on the nature of the business. But now we are seeing, businesses turning their attention to implementing strategies to the reopening of their workplaces in the instances where they were closed. So that's, and I heard someone say very early on, a few months ago, that in a sense, COVID has turned every business into a healthcare business, right? Because everyone is now having to take into account health and safety practices, staff well-being, and all the other practicalities of running businesses under these conditions. But I'd say overall, yeah.
The message that I seem to be getting from you is that they are resilient. They'll ride the wave, and if anything, they'll come out stronger. So they've managed to find. So the system has worked. So banks have kicked in terms of lines of credit. Exactly. Investors have supported them. So that security mechanism has come into place to give resilience or to help these companies build resilience, which is positive.
I think that's right, Omar. I mean, I think, you have to, if there's one thing we've learned from every other crisis that's come before, is that this one too shall pass, right? So as difficult as it is to think about building resilience when you're in survival mode, they've had to do that. They've had to kind of shift from this mindset of capital planning simply for survival mode back to capital planning for growth mode, and really making sure that the operations that they're building now over, these last few months are resilient and ready to take advantage of an upturn whenever that comes.
Okay, and you think that they've got sufficient runway from a financial perspective in general? So support from the bank?
Yeah, I mean, I think, look, and again, as Lucy pointed out, this isn't just an issue for African businesses, right? This is, the World Bank has released their study, and it shows, I think it's a definitive voice now that shows that the global economy on the whole has been plunged into recession. And so, look, I think, but there's always going to be, look, global negative yields are going to probably find flows coming into Africa to seek return. I mean, in the private equity market, which is the market in which CDC largely operates, and obviously private equity is an important funding engine for kind of mid-sized businesses, manufacturing businesses, etc. We are seeing, LP capital going to really experienced GPs. So not just with good investment track records, but also the ones that have a sort of a demonstrated ability to add value, real operational value beyond financial engineering. But those are important sources of capital for our businesses. But we know that what's really needed to grow Africa's businesses and economies really is long-term private capital coming in from smart capital investors. And frankly, what those sorts of investors want to see is not just dynamic business opportunities and really smart management teams, but it also all has to be kind of couched under responsible government and policies and supportive policies. So, be as it may, I think public sector leadership is also definitely going to be another key element in either supporting or delaying the recovery.
And just one question in terms of the companies. You mentioned your 900 mid and senior executives working for these companies. I take it that most of these companies are serving the domestic market as opposed to export oriented. Is that right?
The majority are, yes.
So ultimately, these companies will be dependent on domestic consumption coming back to levels that the pre-COVID levels.
Exactly. And there's, in some cases there's opportunities. I mentioned, we talked about the e-logistics. So one of our members is a CEO of Jumia in Uganda, for example. And this is no surprise to anyone, but it's been going, in one sense, it's been going gangbusters. Just the opportunities for e-commerce and digitization. I mean, it's just so obvious now that through technology and innovation that we can do so much more. And also it's kind of been the backbone. Certainly, I'm sitting here in London, and certainly that's kind of what's kept things going, kept people fed, etc. through all of this crisis. So there's been opportunities there, those sorts of opportunities, but actually there are also, we do need to still invest in technology, right? Because Jumia, they've been sort of the very obvious infrastructural bottlenecks that have kept them from I'd say reaching their potential in this period. But one thing, I talked about pivoting business models. So one interesting thing that they've done, so they recognize that they're the #1 traffic site in Uganda. They get more views on their website than any other platform. So they were able to offer they've actually partnered with the government and talk about, sort of new forms of revenue, but they've partnered with the government now to reach people, to distribute information on the crisis and on the pandemic. But then you have other, businesses. We have someone who's a member who is Ethiopia, and actually I'd say East Africa is one of the largest conference organizers, and that business, right, has come to a complete standstill. Like tourism, hotel, etc. Conference is similar. So the long-term economic impacts there, who knows? People are talking about, well, what we're doing now is what will become the norm, but let's see where that goes. But Ethiopia, Lucy raised the example of Ethiopia. The Ethiopian economy, even though a lot of our businesses are serving the domestic market, actually the Ethiopian economy, as an example, relies really heavily on imports for consumables, but also in the manufacturing sector, right? So I think, with that heavy reliance on raw materials, when the entire global value chain is at a standstill, it just has a huge impact on what's possible, what can be produced in country, and how businesses are able to earn income. So really varied impacts across the board.
Thank you, Nyeros. I'm going to go to Saloshni, who's head of global market sales and structuring at AFSA. And Saloshni's obviously been speaking to a lot of different clients, and she'll have a great overview in terms of what's happening, and in terms of the discussions, and in terms of hopefully a pipeline as well, in terms of new deals, new projects that companies are possibly looking at. So, Saloshni, what's your outlook from the different conversations that you've had with clients that you and your teams have had?
Thanks, Omar. So I think to start, what was really important for us as COVID accelerated the impact, not only on the economy as we saw weak macro fundamentals, and I agree with Lucy around a very slow, protracted recovery, increasing public debt, high levels of debt as a whole across this continent is actually quite critical. COVID just exacerbated that. So we actually took a stance in terms of just understanding the sector themes that are coming through from all the different companies that we deal with, from global corporates to large local corporates, mid corporates and SMEs. And it was mentioned earlier, the big requirement was around funding. Short-term liquidity requirements. There was very little else prioritized, because as flows dried up, companies couldn't import, they couldn't export. So they had to think about how are they going to assess their business models through this period. And in certain cases, depending on the lockdown restrictions, the impact was very severe. If you take South Africa for an example, the economy basically came to a standstill in terms of the corporate activity that was required. And what we did is we actually restructured ourselves in terms of how we're going to deal with the client needs that were coming through, to the extent that we'd have weekly credit meetings. We needed to have decision-making happen a lot faster. And funny enough, the financial industry is not known for working from home protocols. So that was a whole challenge for us in itself. But we managed to, like ourselves and other partners, we managed to turn that around quite quickly. And we've achieved something that we never thought we would have achieved in terms of sustaining the market, supporting our clients through an environment that we've never experienced before. With, if I look at my sales instruction team, 80% of my staff are actually working from home, servicing their clients. And I think clients appreciated that because they had their own challenges. So it was partnering up, looking at best practice in terms of operational and employee efficiencies and sharing that. Then in terms of looking at from a funding perspective, what can we do? And this was quite key because what happened is that there were numerous requests that were coming through. So we had to be quite systematic about it. We had to ensure that we were fair. We had to look at having a very balanced risk model that took into account not only our own balance sheet and capital, but making sure that it was sustainable for all the counterparties involved. And how we did that was through a combination of tools that we could leverage. That could be either interest or capital deferments, that was looking at payment relief, looking at debt restructuring, just increasing facilities as and when they were needed. And depending on which sector or segment you were dealing with, having those deep insights and working with those clients to understand what was going on was quite critical. I mean, many of these companies were faced with very constrained cash flows in a negative growth environment, and with very constrained liquidity. But what was great in a number of these markets, the regulators also came to the party. I mean, the central bank in South Africa opened up liquidity. They allowed banks to continue to provide lending facilities by providing relief from a capital standpoint, which was amazing. I mean, if you look at Kenya, you had the parliament that gave a tax relief in April, and 100% tax relief for anyone that earned less than 24,000 shillings. I mean, these were things, so it was a coordinated effort from all parties across these industries, regulators and central banks. And George will talk a little bit more around what has been happening in the regions. But I think what I really want to focus on is just those sectors actually drive the financial markets. And besides COVID, you had downgrades that came through from a sovereign perspective. We had liquidity constraints within the financial markets. Emerging markets were severely impacted. They diminished quite quickly. I mean, so the South African rand depreciated close to 25% at its peak. I mean, that's quite frightening when you think of a client that has to import goods that budgeted at a rate that was probably less than 4 rand cheaper than where it was before. So really it is understanding what's happening in the financial markets, what's happening with the liquidity conditions that are driving it, what's understanding the sectors that are going to ultimately support these flows as they come back. I mean, the first 6 weeks of COVID flows were not too bad because clients were actually managing the exposures they knew. And we had a lot of interest from institutional clients, both offshore and onshore, into the bond market that sustained our fixed income business. But the corporate activity from April has suffered quite a bit. And I agree that there are positives, and we're going to talk about that a bit later. But a number of our clients are going through quite a distressed period right now. And in terms of how they're going to manage their cash flows into year end, this is where their banking partners and the financial institutions that they face off to are going to be critical in that support. And that's sustainable to both because it has to be shared value. I mean, as banks as well, we have our own capital requirements that we need to fulfill. And so it's always a balancing act in terms of how we drive that. But just that open engagement and communication and staying close to your client relationships has actually managed to support this transition. I mean, we are going to continue to navigate through COVID for another year, and the impact of it is still not fully known. But we are seeing green shoots, and some of my panelists have mentioned that. In the healthcare system, this whole talk around e-health is going to drive a whole new business model and new opportunities for all parties involved because it's going to require investment. We also have a lot of themes that we're focusing on around those green shoots. I mean, online services are critical. I mean, we're going to need investment into ICT and telco infrastructure as a result of that. And I mean, you would have seen, I think it was last month or so, around the Facebook investment that is being planned over the next few years to invest in a fiber cable for the continent. And that means that creates all of the next round of infrastructure projects that are going to be needed. These were always in the pipeline, but what has happened because of COVID is that we've had to accelerate our efforts on all fronts around technology and digitization. I mean, the big thing is around consumer spending patterns, and the investment into online technology and e-commerce is a big focus for all banks because we can't be disintermediated by fintechs. So it's also making us think differently around our strategies and what we are going to be investing in to remain relevant, not only to our employees and customers, but as well as the communities in which we operate in. And another big theme that's coming out is public-private partnerships. Because as we navigate through this, that's going to be a critical area that we have to invest in terms of how we're going to support all these economies that have deteriorated, that will have negative growth for the next 18 months. And I think as much as we want to be positive, there's a lot of headwinds that we're going to face. I think unless we have those partnerships that are quite robust and strong, we're not going to be able to navigate as successfully as we'd like. So I just want to pause there on that note. Sorry, Omar, you're on mute.
I said, thank you, that was very insightful. I'd also like to let all the people who have joined this webinar that they can ask questions using the Q&A feature, and I'll raise them once we've heard from George. There's a couple of follow-up questions. I think one important point that you made, and I wanted to speak to you about, is the role of the regulators. So from what you say, the regulators have played a fundamental role in providing liquidity for the banks and making sure that the system doesn't just clog up and close down because of non-performing loans and others. Is that right? Is that fair to say?
That's fair to say. And I mean, there was engagement very early on between the regulators on all fronts, including the central banks, facing off to all the commercial banks in a number of the countries that we operate in. And it was really understanding what the impact is going to be and how they can support the economy in terms of just driving flows. Because the volatility had increased significantly. And I think that's going to continue into the rest of this year, and it'll be a big theme that we are prioritizing as well. And George will talk to some of the direct themes and conversations that have been happening with central banks specifically around creating liquidity in the markets across Africa.
Okay, fantastic. And tell me, in terms of ABSA specifically, I know that all the banks in South Africa, and yours as one of the top tier one and biggest banks on the continent, you were very well capitalized coming into this crisis. Are you guys increasing provisions in terms of for non-performing loans and for loans that companies that you see may be defaulting on their payments?
Yes, so I mean, in the second half of this year, that's going to be very prominent, but we are not concerned yet. There will be an increase. We are monitoring our, what we call distressed assets very closely. And also impairments are a big focus in terms of how we're going to manage the next 6 months. I think it's in terms of making sure that those opportunities that come through COVID, that we aligned and that we are supporting those to buffer some of the risks that are coming on the other side. And to Niros's point earlier, there is money in the system that can help balance this and help us support and maintain the risks that are there inherently in terms of the increasing risk around defaults. But yes, I think it's how we're going to support those opportunities in a sustainable way that's going to be critical.
Okay, fantastic. Well, it's for me that's very positive actually in terms of the solidity of the banks and the role that they're going to play in driving a recovery, hopefully a V-shaped recovery. George, so you've been speaking to the regulators, as Saloshni has said. You've been looking at it at a Pan-African level as well, given your footprint across the continent. So what's your perspective?
Well, thank you very much, Omar, and thanks to our listeners and those on the screen. I think the first observation really is that the economic impact of COVID actually came faster than the health impact when it comes to Africa. And to a large extent, that probably was a bit of an advantage Africa had over other economies. So the US, for example, crossed 100,000 recorded cases before a lot of the countries on the continent started recording their first cases. Now, with everything else that my co-panelists have said, I think it came together quite interestingly on the financial market and reflected in a couple of themes that we've observed across different markets. So one of the issues which I believe Lucy touched on is the issue of remittances. So we've seen remittances drop across the continent, and I mean, if you look at the data, remittances in Africa has become much more significant in some countries like Nigeria, Egypt, Kenya, Ghana than some of their main exports. So remittances draining out of the markets has an immediate impact on FX flows, for example. We also saw commodity prices going down much significantly before the health crisis actually hit, also impacting a couple of countries, particularly the ones that are more commodity dependent. So almost all the big economies around West Africa got hit quite heavily in terms of lower commodity flows. And then to compound issues, we also saw a lot of exits by foreign investors in the portfolio market. So people who were invested in the equities market or in the bond market, due to everything else that was happening in both Europe and the US, started exiting their positions and drawing down quite significantly in a couple of markets. And all these challenges actually then meant that we were supposed to see a massive devaluation or depreciation of currencies across the continent. And I think on one side, we've seen some massive depreciation. So Saloshni talked about South Africa, where we saw the rand depreciate against the dollar by up to 25%. We also saw a bit of depreciation in Kenya, for example. We've seen some in Nigeria, Egypt. Aside South Africa and maybe to some extent Zambia, which are the continent's most flexible currencies, all the other currencies actually held up quite well compared to what happened in 2008, for example. And you can attribute the ability to withstand this particular crisis compared to 2008 to, I think, a much more organized effort by the central banks. I think we've mentioned that in preparation for the worst case scenario. So, for example, we saw a lot of central banks approach the Fed, or the Fed having engagement with a couple of central banks to make repo funding available, just to strengthen the ability to buffer the kind of volatility we saw in the market. My colleagues have also talked about the injection of liquidity. So that is quite significant, and it helps actually tone down the amount of rise that we potentially could have seen in interest rates. But in addition to that, we also saw an aggressive rate cut across almost all the jurisdictions. So we've seen Egypt, for example, cut up to 300 basis points. We've seen Kenya and Ghana cut to levels that are the lowest in 8 years. And all that were organized efforts to really deal with this pandemic. And I think my summary around the actions of the central bank has been a much more prepared central banks across the continent to deal with this pandemic compared to previous crises that we've had. I think from banks' perspective as well, I believe that as we rightly mentioned, before this crisis came up, Africa saw its own wave of banking sector consolidation. So across various markets, we saw that in Kenya, we saw that in Mozambique, we saw that in Nigeria much earlier on, we saw that in Ghana. So the banking sector was much more prepared from a risk-taking point of view. And I think that offered the stability or relative stability that we've seen in the continent when it comes to the financial market. So listen, it is difficult to conclude that this is how it's going to be because this situation is just evolving. But compared to the same time when the 10 years ago when the financial crisis actually hit, I believe that Africa's financial market has been able to withstand this particular pandemic better than previous crises that came in. And I think we can talk about this later in terms of what else needs to be done to make the financial markets much stronger to be able to deal with future pandemic. I think having said everything that I've said, there is still a lot of work that needs to be done to make the financial sector or financial markets much stronger in future.
Thank you, George. So I've got a few questions here from our audience, and maybe I'll start with you, George. One talks about they're looking at industries and sector-specific questions, and they're saying, what about the construction sector? What is the pipeline for large infrastructure projects like power plants, railways, constructions? Has that been disrupted, do you think, or is it business as usual, given that these things are not dependent on what's happening over 3 months, but what's happening over 30 years?
So, I mean, I will start and then my colleagues can join. From what we've really seen, I mean, the first question to ask is whether a government can continue on its path of development, given the situation that we found ourselves in. And I believe Neros actually mentioned that, and it's not different from what governments were also doing. The focus of government was to immediately shift from more strategic infrastructure development into immediately trying to address the issues of the economy and not really beyond, at least for the first 3 months. Having said that, I believe that going forward, a lot of the governments and private sector are going to start focusing on things that support the sectors that are going to come out of these situation that we find ourselves in faster. So one of the observations Saloshni made, for example, is that the health sector in Africa is probably going to see some significant investment. And that work must start now, right? Because historically, Africans and like the middle income class, etc., relied on other health infrastructure for their own personal health. But now, with everything else that has happened, that focus is going to be internal. There's going to be much more investment in the health sector, and governments and the private sector is going to focus on that. And I think that focus is coming. Immediately, it hasn't been, because you have to deal with surviving now and then think about the future later. But the discussions have started.
And maybe, Omar, to add, education is also going to be massive on the continent. It's something that we've tended to underinvest in, and I think those projects will start to be prioritized. And again, I think the question there around power and rail is important, but governments are going to prioritize the projects that they will be delivering over the next 5 years. And I think in terms of power, you're going to see an increase in independent power producers being more prominent and the support that brings. And another big thing to monitor now is around how government is going to support manufacturing in terms of local content and how they will partner up with the private sector in terms of doing that.
And you spoke, Saloshni, of PPPs. So, you know, we've got on one side governments that are now more indebted than they were to, given the support that they've had to give their economies. So PPPs are going to have to be more prominent and going to have to be fast-tracked to get the private sector involved in some of these projects. Is that right?
Yes, and I think the big thing that we need to resolve is just quicker decision-making and less bureaucracy around those transactions and agreements that go with it. But I think there's an imperative now to get it done, given the impact we've seen of COVID. So I think it's to watch that space. I mean, as a bank, it's something that we're quite focused on. And I think we're going to see momentum over the next 6 months in terms of how we deliver projects and programs through PPPs and what that will look like. And I think we need to set a precedent in terms of the turnaround around that as well.
Yeah, I think one thing that this crisis has shown everyone is that governments have managed to act and do things that they never thought would be possible in a very short time frame. So it showed that it is possible where when needs demand it. So I've got a question which is about mergers and acquisitions, and maybe we'll go to Neros for this. I mean, the question was about the depressed valuation of banks. Would that create an opportunity for local or trans-border mergers? But I want to widen that actually. In terms of the companies that you're dealing with, do you think we may see some appetite for I don't want to call it greater collaboration, but for groups coming together and more mergers in different sectors? Yeah, Ross.
Well, I'd like to think that in an ideal world that's that's what one would be hoping for. But unfortunately, I mean, if there's one thing that certainly if we differentiate between sort of, that sort of activity happening across borders versus happening within countries, one thing that this crisis has showed us is that across the world, governments and companies have tend to sort of, they're now looking inwards, they're nationalizing. It's almost like the opposite of globalization has been happening. And I think, if you translate that to what that looks like in the corporate sphere, it's just, with finite resources, people are going to look inwards and first be concerned about shoring up their businesses. Now, in terms of whether there's opportunities opening up, historically, again, if I use the Africa list as a platform from which to kind of draw insights, our members are very, very keen to sort of establish connections across borders, because a lot of them, especially in the regional blocks, recognize that that's where growth is going to come from. I mean, we've seen that in the banking sector, we've seen that in the telecom sectors and several other sectors, even in agriculture now, that's starting to become a reality. But I think in the very sort of near and certainly even up into the medium term, that companies, similar to the way governments have behaved, are going to have to look inwards and shore up their own positions. And to the extent that you do see M&A type activity, it'll probably be of the form of companies that are in a good cash position, taking advantage of opportunistically taking advantage of entering into alliances with companies that are otherwise struggling and perhaps not looking likely to survive.
Okay, I've got a question for, I think this is for Lucy. So, and I think you've answered it somehow, but maybe you want to be more explicit about it. The question is, in a situation of business unusual, where at every level, public, private, etc., are compelled to review how they do business, banks are adjusting rating models. Why are rating agencies operating business as usual?
I mean, to be honest, this is not a question for me. I'm the sovereign risk analyst at Moodys, and I mean, so I can tell you that as an analyst, my operating, the way I operate has changed. Like I'm sure everybody else in that panel because of the pandemic. So, banks continue to do what they do. They lend and restructuring loans, or giving moratorium, actually part of activities that banks have been doing. It's not new. It's maybe bigger than usual, and there's the regulator, maybe a bit more less restrictive in terms of what this means for the different prudential ratios. So we continue to do what we do. But if the question is really about the operating environment, honestly, I'm not the person at Moodys who should speak about that.
But actually, Lucy and Omar, if you don't mind me jumping, but how about, I mean, because the rating agencies do evolve their methodologies over time, and is this something? This is certainly something that feels big enough that there will be a review of.
We updated our methodology for rating governments actually end of last year, so we have a recent one, and the framework, it's really a framework that can help us look through shocks and crises. So from that perspective, we are well equipped from a methodological perspective.
So Omar, if you don't mind, just a quick one on that point. So what we've observed across the continent and also coming from ourselves is not necessarily adjusting your ratings per se because of the pandemic. It's really to recognize that the times have changed and customers and individuals need help and support. And I think from an AFSIC perspective, that is where we've stepped in line with what governments are doing to really support certain individuals and customers who are struggling through payment holiday structures in South Africa and across the continent. So that is really what the banks are doing. And in AFSIC, definitely has been actually involved in giving customers this payment holiday to alleviate the pressures that the pandemic brings.
Okay, and maybe Lucy, one more question to you. It's I think from Nigeria, and and they're looking at what is the impact on countries that are commodity dependent like Angola, DRC, Equatorial Guinea, and Nigeria. We've obviously seen the price of oil rebound to some extent, and commodities are faring pretty well. I mean, iron ore's not doing too badly. So do you think that commodity exporting countries will be more hit than the others?
I mean, for at least the one exporting oil, you know, we've been clear. We published our, we have range for oil price, and we know, you know, the high level of uncertainty around, you know, oil price. But you know, for 2020, we expect an average, you know, a fall, and then after, you know, a slight rebound. So you know, obviously, oil dependent economies, from either an export perspective or a government revenue perspective, are, you know, are more affected than, let's say, you know, West Africa, where all, you know, your countries are actually all imported so far. So to that extent, yes, bearing again in mind the degree of uncertainty around oil prices. And you know, and